The price of a rare tulip bulb on the futures market in Amsterdam in January 1637 was equal to 10 times the annual wage for a skilled crafts worker. A single bulb was reportedly exchanged for 1,000 pounds of cheese at the height of tulip mania. The market collapsed precipitously starting in February 1637, bottoming out in May 1637. According to economist Brian Dowd, by the height of the tulip and bulb craze in 1637, everyone, rich and poor, aristocrats and plebes, even children had joined the party. Much of the trading was being done in bar rooms where alcohol was obviously involved. Bulbs could change hands upwards of 10 times in one day. Prices skyrocketed in 1637, increasing 1,100% in a month. Bitcoin, the original cryptocurrency, was valued at 8 cents in July 2010, $8,100 on November 20, 2017, and $17,900 on December 15, 2017. The sky is apparently the limit. The danger, of course, is not just that at some point, the bigger fools, the last purchasers of Bitcoin and the long-term holders, hodlers in crypto speak, will lose some or all of their money. That would be regrettable. But like straightforward pump-and-dump market manipulations of a stock, some will win while others lose. But, as in 2007 and 2008, the creative greed behind global financialization is creating not just a bubble in Bitcoin and many other cryptocurrencies as investors, as in Holland in 1637, pile into markets as buyers. There is a real and, I believe, rapidly emerging threat that Bitcoin and its ilk could follow dynamics similar to mortgage-backed securities as the basis for highly leveraged and complex financial instruments, like credit default swaps that were traded in unlimited volumes with no limits based on the actual number of mortgages. Cryptocurrency has now entered the leveraged futures market. Speculators now can leverage futures purchases 15 to 1. This means a 7% drop in the price of Bitcoin, a familiar phenomena, will wipe out your capital, returning us quickly to the momentous margin calls of 2007 to 8. And there is no limit to the number of futures contracts. Derivative instruments of more complexity and undefined risks are almost certain to swiftly appear as they did in 2007 when, for example, insurance giant AIG took enormous bets to earn premium on credit default swaps on mortgage-backed securities. After all, these were AAA rated. The sudden collapse of mortgage-backed securities led to a liquidity crisis. The securities could not be sold for almost any price and the giant financial institutions on wrong side of the bets were suddenly bankrupt. As Francis Coppola in Forbes points out, as more and more financial institutions with connections to the real economy pile into the cryptocurrency mania, the chances of a similar disastrous collapse rise ever higher, and along with it, the likelihood of Fed or even a government bailout. The intent of those driving the explosion of cryptocurrency prices is not a desire to use cryptocurrency as a low-cost, reliable medium of exchange verified by a transparent blockchain, but as a magic carpet to wealth. If you bought $100 worth of Bitcoins in 2010, they would be worth $1.79 million as of December 15, 2017. It is paradoxical that cryptocurrency, allegedly meant to free us from fiat currency, finds its liquidity and value in the almighty dollar. There is much to recommend blockchain for its potential use as a reliable and low-cost means of trade, whether it is tied to cryptocurrency or not. For example, blockchain is being used in Brooklyn, New York to test sale of solar energy from local producers to local buyers, with the exchange medium in dollars, not cryptocurrency. The Media Lab at MIT is working on designing cryptocurrency projects that could facilitate, for example, trades and transaction by the global poor purchasing and selling locally produced community renewable energy. Cryptocurrency and blockchain could be an important tool for people not just beyond power lines, but who live unbanked and with little access to cash or liquidity of any kind. Cryptocurrency could become a reliable exchange medium and basis for a community-controlled economy. Bitcoin is also seeing the transaction costs for Bitcoin transactions soar, rising to $20 charged by blockchain miners whose computers verify transaction and at the same time create more blocks and produce more Bitcoins as part of the solution of the algorithm that verifies transactions. Far from being a means for vague quick cheap, anonymous financial transactions, Bitcoin is becoming slow and expensive to use. A newer generation of cryptocurrencies like IOTA offers an improved blockchain with zero transaction costs and faster transaction, all the better to attract investors. Cryptocurrencies could represent a tool for self-management and community economies, a way to use the internet to help challenge the growing netocracy of the Googles, Facebooks, Twitters, Amazons, Alibabas and their ilk. But by making cryptocurrency into an investment who uses part of a get-rich-quick scheme as opposed to a free instrument of exchange and trade, it has become just another arrow in the quiver of making the rich richer and worsening the already grotesque distribution of income. Cryptocurrency speculation will make some people rich, as does day trading and house flipping, where many more will lose than win. I suppose the original sin of cryptocurrency was to allow its purchase in dollars, and not, for example, in services provided by one to another based on labor time and materials. But the cryptocurrency model is based on a limited quantity that makes it resistant to inflation, but enshrines scarcity and therefore value in the siren calls of greed and desire as it does for scarce commodities like cocaine or diamonds or gold. The Bitcoin and cryptocurrency bubble will not end well.